And we are live. All right. So, welcome everybody. Today is, what is today? December 17th of 2024. And it is going to be the last show of the year.
Yeah, that's right. That's crazy.
Yeah. So, welcome everybody. I'm Neal, and we got Serena Fatmas here.
Hello.
We may have somebody else joining us today, but maybe not.
Right.
Um, So yeah, it's been actually a couple of weeks since we had a show, and I was sick and Serena was sick, so it was a whole thing. But we're back, and just in time for the end of the year. So well, let's dive into it.
Mm.
Just don't have any time to waste. All right, so I am your host, Neil McSpadden. This is the $1 trillion show, and why is it the $1 trillion show? Well, because that's our goal. The goal is to save Americans $1 trillion in taxes. And the way we're going to do that is by bringing tax strategy, tax planning at scale. And there's a lot of different ways to do that. But we'll talk about a little bit of one of them, and then we'll get into some current events in the tax world, and then we'll get into the Q&A. So, this is how we're going to do it. It's going to scale tax saving strategies through technology. And you're looking at technology right now, as a matter of fact. So I'm Neil. I got into the whole tax world because I owe the IRS over $1.3 million. I got all the nasty letters. I got the phone calls. I got the garnishing of my paycheck, which is actually what got me off my ass and fixing my own tax problems. But that's how I got into the whole tax world. And over the last 15 years, working on 50,000 tax returns, yeah, I've learned a thing or two about how the whole thing works and how we can systematize uh, reducing tax burden. So what? How do we do that? So there's many ways. One of the ways is what I'm calling the starter course. And this is a course that I put on our learning portal of our Explorers platform. And you'll learn more about that uh, at the end here. But it's available. We have two levels. So Explorers is free for anybody who wants to join, and you'll get notifications about events like this, and you know you'll get updated news and information, the latest on the tools that I'm developing, all that kind of stuff. And then our paid group is the Navigators, and it's pretty cheap to be honest. If you are looking at buying something like the starter course, just get the Navigators because Navigators get everything for free. The Navigators next week we're doing a workshop on S corporations, and that's just going to be for Navigators. So lots of bonuses for being one of the Navigators. Um, but then questions. Before we get to questions, I do want to have a couple of announcements. So there's been a lot of news in the last 2 weeks, really. So news number one, we keep getting questions on, is beneficial ownership information report. And I put up a blog post about this, but basically, back in March, so just to recap for everybody, back in 2022, I think it was, there was a law passed, and it was one of these big omnibus bills that included 1,000 different things. One of the things it included was what is called the Corporate Transparency Act. And this created a requirement that kicked in this year for any entity, basically small business, more or less, that registers with a Secretary of State. So, like if you have an LLC, for example, um, that has to file a report with the government, with the feds, and they would have to report the company information, and then they would have to report any beneficial owner, whether they own directly or indirectly, 25% or more of that entity. And I did a whole bunch of blog posts early in the year about like how to fill out this form. It's not super complicated. Basically, it's name of the company, address, then each 25% owner, their name, their address, copy of their driver's license, and they just want to know, right? It's not a tax. There's no fees. You can do it yourself for free. Obviously, a lot of people are out there charging for it, and there were immediate problems with this. So problem number one, the problem that I have with the whole thing is that all the information they are asking for are things that are already in government databases somewhere. So, like your driver's license is with your state, the state registration is with the state, your social security number is with the feds. The ownership structures are on tax returns. So all this stuff is already there. They just wanted it in their one little honeypot, so they didn't have to go and ask other government agencies for this information if they wanted to. And the rationale that they always give is the same thing they give for everything for combating money laundering and terrorism financing, which you know as general goals go, I'm not terribly opposed to, but it's just this is a stupid way to do it. Um, and the penalties if you don't comply are severe. So back in March, a trade group of small businesses filed a suit in the federal court, and the judge in that court case said this is unconstitutional. And that was in March of 2024. I wrote a blog post back then. You can see it on our taxsherpa.com blog. And the Treasury, the Department of Treasury, which is all this falls under Treasury Department, they said, okay, we're not going to enforce it on the members of this trade group, but everybody else still has to do it. I'm like, that's not really what unconstitutional means. It's not unconstitutional for these people, unconstitutional for these other people. That's just not how it works. Um, and they're appealing, and that's still ongoing. There was another court case in Texas this time, and it was a federal court again. And in this case, and the decision came on, I think it was the fourth, the third, something like that, a couple weeks ago. The judge in that case said it is likely unconstitutional and issued a temporary injunction against the federal government from enforcing any of this kind of stuff. So, for the time being, the status is that this is not enforceable. The federal government is prevented from any enforcement action, and we're waiting and seeing, basically. So that's what's going on with the BOI. We get at least one of those questions a day, I would say, from
Yeah, that's true.
from from clients and other people. And there's a blog post on it that you can check on the Tax Sherpa blog. Other stuff that is going on is that everybody is asking me what's going to happen this upcoming year with the Trump administration. Now, obviously, we don't know. That's the
Yeah.
short answer. But the long answer is that Trump has said a lot of things as far as campaign promises and whatnot. The one that I think is very likely to happen is to take the Tax Cut and Jobs Act, which was the tax reform that Trump passed back in 2017, and make that permanent. Because when it was passed originally, it had a 10-year time horizon, and that has to do with how it was passed, and it was a budget reconciliation thing, um, more arcane than we need to go into. It's set to expire in 2026. And so one of his campaign pledges is to make it permanent rather than expiring. I think that's super likely. The other stuff, the taxability of Social Security, taxability of tips, taxability of overtime, those are all up in the air. Who knows what's actually going to happen there? It would be great if all those were passed, and it would be great if the corporate income tax were lowered, and it'd be great if we have all these things. But we will see. Um, so those are kind of the announcements. So I know I'm kind of rushing through stuff because it's the last show of the year. So so the answer to every tax question is
It
it depends,
Yeah.
which I know everybody hates, but it really is true. It depends on what we call facts and circumstances. So the what is true for one person is not necessarily true for another, and I can give you example after example as to why that is and how it is. But I guess it might be easier just to jump into the questions and we can demonstrate how it depends.
That's
So,
true.
so Serena, what do we have on tap here?
So we have a client that asks, are there any tax saving opportunities I should consider if I plan to invest in a retirement account or other saving vehicles in 2024?
Um, yes, that's the shortest answer. So retirement is a broad topic, and savings is even broader, right? So let's talk about retirement for a second first. Retirement accounts, and there's many different types, are special accounts that are separated for tax purposes for the goal of funding retirements of Americans. Now, there are these special accounts because what the government is trying to do in, varying degrees of success. What they're trying to do is they're trying to get more people to pay for their own retirement rather than relying on the government. Because I don't know if you've heard, but Social Security is going broke. Um, each year, the Social Security Administration, which is, they're the ones who administer the payments of Social Security, they issue what they call the trustees report. And we'll get a new one here in a couple months. And they look at the projected benefits over time, and it's like a 75-year time horizon. The projected income from Social Security taxes, and you know what's going to happen with those numbers. So years ago, we already passed the point where Social Security taxes are less than the Social Security payments that are going out the door. So the money coming in is less than the money going out. That's a problem, right? Now, the reason why Social Security is still a thing is because for decades, from the 1930s up till about 10 years ago, the taxes coming in were greater than the benefits being paid out, and so the uh, the excess was borrowed by the rest of Congress to spend on whatever, and Congress gave the Social Security Administration treasury bills, basically, so savings bonds. And the social that's so hard to say. Social Security Administration has been cashing those in to make up the shortfall from when the taxes coming in are less than the payments going out. And in about 8 years ish, plus or minus, depending on which report you read, that amount is set to run out. And at that point, something needs to give. And either benefits are going to get cut, or taxes are going to go through the roof, or some combination. And that's just how the math works out. So back in 1973, I think it was, they saw this problem coming. This is not a new thing. It's been 50 years that they've been trying to deal with this. They passed ERISA, which was the Employee Retirement Income something Act, um, whatever it was. That's what created the 401ks and the 403bs and the 457s. Those are all code sections of that bill. Um, and so all of these things are an attempt to get Americans to save and invest for their own retirement so that they don't have to rely on Social Security. Roughly, 50, something like 50 to 60% of Americans in retirement rely on Social Security, like almost exclusively, where if they didn't have that, they would not be able to eat. So it's a big problem, basically. And so in order to incentivize this, Congress has these rules where if you contribute to these plans, you get a tax deduction. So, uh, you know, originally there was what we now call the traditional plan. So traditional 401k, traditional IRA, traditional 457, on and on. And what the way that works is you put in money now, and that money you don't have to pay income tax on today. It goes in, and it's what's called tax deferred. And then it goes into that account. Theoretically, it grows and grows and grows. And then in retirement time, you start taking that money out. And when you take that money out, then it becomes taxable at that point as just regular income. So you avoided regular income tax today in order to pay regular income tax tomorrow. That's kind of the deal. And a Roth is the opposite. You pay the regular income tax today on however much you put in, but you pay nothing when you take it out in the future. So, in fact, Serena and I had a call with a client today, and we were talking about, it's like, oh, you have a low income year. Do you want to do traditional to Roth conversion? We were talking about the pros and cons of that as far as whether it makes sense for their particular situation. And it really depends on what you think is going to happen. So it's not a it's not a simple thing like a lot of people like to make it out to be. So traditional plans of various kinds, 457s, SEPs, 401ks, IRAs. You take the tax break now, and you can take the tax hit later. Roth, you take the tax hit now, and you have no tax later. So that's the basic idea. Um, whether that is a strategy, I mean, it is a strategy for sure. So one of the things that we do, especially with our small business owners, is that if let's say, if they have an S corporation and they have to pay themselves a salary, just because those are part of the rules of reasonable compensation, all that kind of stuff. We will build in retirement plan savings that are traditional in that they can get tax deductions today. Um, and there's a lot of optimization that goes into that that allows for really significant savings. So that is definitely a way to go. You know, oftentimes, if you build it right, you can get the money that you put into that traditional retirement plan to effectively be free because, again, if you structure it right, the money you put in is basically equal to the tax savings you create through the various strategies. And so, you know, it's almost like free money. So, which way you want to go, traditional versus Roth, is subjective and depends on your assumptions, but that's kind of the basic idea. As far as savings goes, savings typically is not going to be a tax strategy in and of itself. It's going to function more similarly to like a Roth retirement account. Um, and it depends on what savings vehicle you use. So we have a lot of people, a lot of clients who use the infinite banking concept. I use the infinite banking concept. And in that, basically, you are saving, um, quote unquote, it's not technically savings, but you are paying into this plan that creates uh, it creates a pool of capital that you can borrow against in a tax-free way. And so sometimes that can work out really well, but it's not so much a tax strategy because you're contributing after tax dollars similar to a Roth IRA or Roth 401k, but you are creating a pool of capital that you can access tax free through loans against that cash value. So there are things to do. They're not so much tax wise, but there are things to do. And yeah, I mean, I could go on and on. I will say one other thing about the 401ks and the IRAs. I've seen thousands of people with retirement plans over the years. Most of them don't work. And the reason they don't work is, well, there's a couple of reasons why they don't work. So reason number one is because they can't leave it alone. The plan only works if you put the money in and you invest it in whatever you want to invest it in and leave it alone. You have to give it time to grow. So if you cash out your retirement plan for vacation, for remodeling your kitchen, these are all actual reasons I've heard. Um, if so, the two good reasons to cash out your retirement money, your retirement funds, is job loss and illness. Um, for those, I understand it's still not great, but I at least understand why you tap that capital. But still, it doesn't work if you don't leave it alone. So that's the whole thing. The other thing, the other reason why they don't work is because people don't put enough into them. So I've seen many, many people who I've seen, just to pick nurses off the top of my head. I've had many, many nursing clients over the years, and um, it's very common that by the time they're retiring, they're making 80, 90, 100 grand. And that's not even counting travel nurses who make more, but just regular nurses in your local place. Um, so let's just say $80,000 is their retiring salary, and then when they retire in their 401k balance or 403b balance, they have $110,000. So $110,000. If you spread that out over 30 years, not a lot. It's like $4 or $5,000 a year, and factoring in growth and everything. And so what people do instead is they just, spend it all in, 1 to 2 years. And then they're just stuck on Social Security or on their family. So the people who have made retirement plans really, really work for themselves are the ones who make enough money so that they're able to aggressively fund these plans, and they are able to leave that money alone to work over their working lifetimes. And by the time that it gets to retirement age, there's a couple $1,000,000 in there, and now you're starting to get significant income in those retirement years. But if you can't do those two things, then it's fundamentally not going to work for you. Um, so there's a whole lot of it depends.
Yeah, I was gonna say, yeah, it depends on the person.
It depends. Uh, all right. What else do we have?
So we have an S Corp shareholder that's looking for distributions. He asks, I am an owner of an S corp. We had a very good year with profits, and he's wondering if it's better to take salary or just to take distributions from the company or both. And how does this impact the 1120S tax filing?
Yeah. So um, that is a big it depends.
Yeah.
Okay. So with S corporations, the reason why S corporations are more efficient than other types of corporations is for two things. One is that they are a pass through. So the net pro so an S corporation files its own tax return, Form 1120S. It has revenue at the top, it's got all of its expenses, and at the bottom there's net profit. That net profit gets passed through to its owners. So if there's three owners that are each a third, and there's $30,000 at the end of the day, then each owner is going to get $10,000. That pass-through income is going to get included at that individual's individual income tax. So on their 1040. And so individual rates are going to be less than, on average, they're going to be less than corporate income rates when you factor in the corporate income tax and the dividend tax if you take money out. And there's a whole lot of math as to why that is, but just take my word for it for the time being. So because it's a pass through, it is more efficient than C corporations in most cases. The second thing is that the profit from an S corporation is not subject to self-employment tax like a partnership would be or Schedule C would be. So self-employment tax is the personal version of Social Security Medicare tax, 15.3% tax. And so if you have profit, then from an S corporation, you can take that income, you get the individual income tax rates on it, which are generally going to be lower than corporate rates, and you don't have to pay the 15% self-employment tax. So that's why S corporations 92% of the time are the way to go. Now the other eight is, varies, depends on the situation. But 92% of the time, S corporation is the way to go. So on you know, Congress made these rules, so it's not like they don't know how it works. And so there's a huge incentive, this 15% incentive, to put everything into profits instead of taking a salary from the corporation. And so there is a countervailing rule called the reasonable compensation rule, where if you are providing services for the company and the company can afford to pay it, which is a key caveat, then the company is required to pay you a reasonable compensation, whatever that means in quotes, for what it is that you do. And that applies on first money out. So you have to take salary first, and then you can take profits. That's basically it, if there's profits in excess of your reasonable compensation. So that's kind of the background. Now, as far as which way is better, obviously the the profits is better tax wise, but you have to take into account these other things. So, how much is reasonable for reasonable compensation? Depends. Depends on what you do. So there are, two different extremes. So extreme number one is you as the owner have no involvement in the day-to-day operations of the business. You are really just an owner. You have professional management. You have employees doing stuff. In that case, you should not take a reasonable compensation salary because you're not doing anything. You're not providing any services to the business. And maybe you're a board member, you could get some token honorarium, something like that. But if you're really hands off, then that's it. Your reasonable compensation is zero. Everything should be profit, and you should get the maximum tax advantage there. If, on the other hand, other extreme, it's just you, right? You're the only one working in the business. Everything comes from your labor. Then an argument could be made that you should have zero profits and you should have all reasonable compensation. The truth is usually somewhere in between, right? So one of the approaches that has stood up in court is to keep a log of what it is you do on a day-to-day basis. Because one of the things that people, overlook is they think I have a business that, I don't know, does property management, let's say. So if I go out and I look at property management salaries, I can look on salary.com or Indeed or one of those, and you can find some number, right? Based on, geography and whatnot. That's not the number. Just because the business does that thing does not mean that's what you're actually doing. Because every small business owner, not everyone, but most of them, uh, most small business owners are doing all kinds of things. So they're doing the the product or service that is being sold, like property management, but they're also doing admin work, and they're also doing marketing, and they're also doing sales, and they're also doing management, and they're also doing collections, and they're doing, bookkeeping, and they're doing, all these different things. And these are all different jobs that all have their all different rates of pay. And you have to weight those. We don't have to, but this is an approach that has worked. You weight those by the amount of time that you are spending doing them, and then you come up with a global average of what your reasonable compensation should be. And that number is going to generally be less than the full market rate of providing that good or service of property management. And it's less than because these other things have lower economic value. So, so you end up with, I'll just pick numbers here. Let's say you hire a full-time property manager, it's going to cost you $30 an hour. When you factor in all these other things that you're doing, your real rate is $22 an hour. And then you figure out however much time you're working, and there's your salary, and the remainder goes to profit. So that's the first pass approximation. Now, when you get into tax planning, then other things start to come into consideration. So consideration number one is, like we just talked about, is retirement stuff. So if you let's just say let's say you take a salary of $50,000 from your S corporation, then you could contribute up to $23,000 of your 50 to your 401k as an employee. And potentially, your employer, the S corporation, could kick in another 12.5 as an employer match, because the employer can kick in up to 25% of the wage towards an employee's retirement plan. And so you could so between those two, you're up $35,000 worth of deferred, taxable income that's going into that 401k. So, that's factor number one. Factor number two becomes that if the numbers are high, like you have a lot of profit, then we get into optimizing on the qualified business income deduction. This is one of those tax cut jobs things where pass-through entities have up to a 20% break on their income for tax purposes. So if a company makes $1 million, you might only pay tax on 800,000 of it, because you get a 20%, up to a 20% qualified business income deduction. Now, part of the rules with qualified business income deduction is a wage test, which is 50% of the wages paid. So there are circumstances where we actually want to increase salary, and because we're already above Social Security cap, we'll pay some Medicare tax, but we'll gain the QBI on the other side, and we come out with a net positive result. So there's a lot that goes into S corporation planning because of that. Now, one other thing about S corporations is that if the S corporation makes money, it does not matter for tax purposes if you take the money out or leave it in. And a lot of people get confused by this. So if the corporation makes money, there's a net profit at the end of the 1120S. That profit will be taxed whether you distribute it to the owners or whether that money stays in the company as retained earnings. So just be aware of that. It's like, oh, a company made 500 grand. I was like, oh, but I didn't take anything. So it doesn't matter. It's still passing through. So just something to be aware of. So as far as which is better, depends on the situation, depends on what else is going on in your tax world for that year, and depends on all these other factors as far as, like, what are you doing tax planning wise. So it depends.
Yep. Another it depends question.
Yeah.
So we have someone that asked, can you walk us through, Neal, the most important sections of the 1120S form, especially for those of us who are filing for an S corp for the first time?
The most important parts, I mean, all of it, but okay. Let's bring up 1120S. Oh, this is the new version, 2024. All right. Is this coming up on the screen? All right. I think we're good. Yeah. Okay. So the most important part is, well, actually, this number right here, line 22, ordinary business income or loss. That's the number that is going to be passed out to the owners. And so, when you do a S corporation, revenue goes up here. So a tax return is sort of a modified profit and loss statement. It's not quite a profit and loss because there's differences between book and tax, but that's kind of the basic idea. Um, so, you have your revenue up here, revenue of different kinds, and then you have your expenses. So compensation of officers, that's usually where the reasonable compensation goes. Salaries and wages to other people, and all this other stuff. These days, so when these tax returns were devised, it was, we had a very different economy. It was kind of devised for brick and mortar industrial type businesses. These days, most businesses are service based. And so most expenses end up in other, line 20. So it's very common to see an S corporation, there's some number up here, all these are blank, and then a big number on line 20. And then, line 6 minus line 20 gives you line 22. And that's kind of the long and the short of it. So things to make sure you get right. So one is your S corporation, your S election effective date. So in order to get an S corporation, you have to elect this treatment with the IRS. It's a form called Form 2553, and you have to make sure that you file that with the IRS, and you have to make sure that it gets accepted. This is one of those things where the IRS cannot seem to do their jobs. Um, I was working with on a client's file today. 2021 filed 2553. We filed an S corporation return. Everything went through fine. 2022, we filed an S corporation return. Went through fine. And then later, we got a notice. A year and a half later, we got a notice from the IRS saying, "Hey, we received your S corporation return, but you can't file as an S corp because you didn't file Form 8832." And it's like, in 1999, this rule changed, where in the old days, before 1999, if you had an LLC, you had to file, if you had first elect, I want to be treated as a corporation, which is Form 8832. After that was processed, you had to file Form 2553, which is, okay, corporation changing to S corporation. 25 years ago, this rule was changed, and still there are people at the IRS causing problems because they don't know the rules. I actually had to look up the regulation. It was it's a very long citation. But anyway, so when you file the Form 2553, 6 to 8 weeks later, you get a letter in the mail from the IRS saying notice of acceptance of as S corporation, and it has a date on it. Sometimes, if things get screwed up, that date is wrong. So right now we're in 2024. If you filed the 2553 either past 75 days from the start of the year or the start of the corporation, you might get a date saying, "Hey, we've accepted you, but we accepted it as 1/1/25." And for 24, you're still whatever your default classification was. So you got to make sure that date is right in order to prevent problems with processing. You got to make sure your EIN is right because that's how the IRS identifies everything, is by tax ID number. Some people get confused and they're not sure if it's social security number or what. The company's tax ID number is different than your personal social security number. And then from there, you got to make sure the numbers are right. And that comes from doing the books, right? You got to say how much revenue came in. You got to list how much deductible expenses that you have. So, where people screw up on expenses is a couple places. One is interest. So, if it's like in real estate, for example, a lot of people will say it's like, "Oh, well, my rent, I collect rent at 3,000 a month, but after I pay all my stuff, I'm left with 200 a month." Okay, it's like, well, in all those payments, were you paying a mortgage? Yes. Is your mortgage principal and interest, or is it interest only? Most people have an amortizing loan and it's principal and interest. The principal is not deductible. That is just, you didn't pay any income tax when you got the loan, and you don't get any deduction when you pay back the loan. You do get a deduction for the interest, which is on top of that amount. So you got to make sure you have your interest correct. Depreciation is screwed up all the time. uh, that's beyond what we could cover in the next 30 minutes, to be honest. But depreciation is when you have a capital asset that lasts more than a year, which is a lot of stuff, actually. And there's like under a certain amount, it becomes de minimis, and it's not important to capitalize. But um, furniture, equipment, cars, real estate, office type stuff, all of those last longer than a year and get depreciated. Now, how it gets depreciated depends. There's different categories, and within those categories, there's different options of how it gets depreciated. There's straight line depreciation, there's 179 deductions, there's bonus depreciation, and all these things intermingle with how much you want to deduct now versus later. So, you know, sometimes there are cases where it's like, hey, we don't need any aggressive deductions this year, so we're going to defer those those depreciation expenses as far out as we can, and then so they'll be there when we need them, when we have more net income, or whatever the case might be. So those are all things that people mess up a lot. Now, the I don't know what number I'm on. Fourth most important thing:
Mhm.
if your revenue is over $250,000, there's a whole other thing you got to fill out, and that is the balance sheet. This guy, and so this is related to the balance sheet that you have on on your bookkeeping statement, but it's not quite the same because there are different things. Like one of the things that a couple of our clients have been caught by is software development expense. So, as part of the Tax Cut and Jobs Act in 2022, I believe it was, there was a rule change where software development expense had to be capitalized. So, if you pay some guy to make a piece of software for you, let's say you pay that person $100,000, that $100,000 does not get a deduction. It gets capitalized for 5 years. It goes 10,000, 20, 20, 20, 20, 10, 20, 20, 20, 10 as far as like the spread of how all that works out. And then you get a tax credit for increasing research activities. But the net effect was that you ended up with more net profit than you actually had on a cash basis because of this particular treatment. And that capitalization gets included on the balance sheet as an intangible asset. So there's weird stuff that happens, but that this only kicks in if your revenue is over 250,000. If you're under 250, which is most businesses, then you can leave Schedule L blank. Um, and then there's a whole bunch of check boxes and all kinds of stuff. But that's kind of the basic idea and the things I see people get wrong a lot.
Okay,
So
that's it.
I think that's it for now. I mean, each one of those I could go on and on, but I think I'll limit myself for the time being.
Right, right. No worries. So I have a retiree question. So a client asks, I'm planning to start drawing from my retirement accounts in 2024. How can I best structure these withdrawals to minimize my taxes and avoid penalties?
Well, penalties, there's only two types of penalties for retirement account withdrawals. One is if you're too young, and the other is if you're too old. So if you're younger than 59 and a half, you have a 10% penalty for pulling out retirement funds. There are a couple exceptions to the penalties, but you know, pretty much if you're under 60, you're going to be paying 10% extra. Now, if you wait too long, if it's because once you hit age 72, if you have a traditional plan, then the IRS requires you to start withdrawing funds, and that's called the required minimum distribution. Now, if your IRA or whatever is with one of those a financial services firm, they're going to send you that money whether you want to or not, because they're not going to get hit with any of these penalties for holding on excess time. Where people can get into trouble is with self-directed plans, because there is no company out there keeping an eye on you, and there can be instances where you miss your RMDs, so your required minimum distribution. So once you hit age 72, it used to be 70, now it's 72. You have to be mindful of those RMDs. Now, as far as avoiding or dealing with the tax hit on those, there's a couple things. So one is if you are charitably minded, there's the QCD, the Qualified Charitable Distribution. And this is where instead of the money coming to you and then you taking it and doing whatever you want with it, the money goes from your retirement plan straight to a charity, a 501c3 type of charity. And if you do that, then that money counts towards your required minimum for that year if you're over age 70, and you don't have to pay tax on it because it never gets to you. So that's a more so if you're charitably minded, that is a more efficient way to go than to take the income from the retirement account and then giving it as a charitable contribution to that charity. The reason it's more efficient is because charitable contributions are part of your itemized deductions. Now, in itemized deductions, there's you total up all your itemized stuff. So medical above 7.5% of your income, state and local taxes up to 10,000, mortgage interest under 750K worth of mortgage balance, charitable contributions, and then a couple miscellaneous things. So if that you do all that and you add it all up, if that number is less than your standard deduction, which is going to depend on your filing status, then you just take the standard deduction and move on with your day. Most people, especially since the Tax Cut and Jobs Act, most people take the standard. They just don't have enough itemized deductions that qualify. And so the only way in which the QCD and the take the money and then contribute the money would be equal were if your itemized deductions, not including charity, were already over your standard. And that's super rare. It's either you have an enormous mortgage or you have enormous medical expenses, neither one of which is really good. Um, so, um, so it's because of that standard deduction hurdle, it's generally more efficient to do the QCD where you're giving that charity directly from your retirement account, and then you don't have to pick up the income on your tax return. You have to show that there's distribution, but it's not taxable. So that's thing number one. Thing number two, when it comes to dealing with retirement income, is that retirement income, if it does become taxable, is income. It's just ordinary income. So all the strategies that apply to any other kind of ordinary income are also going to apply to retirement income. So if you have a real estate portfolio, there's all kinds of things to do there. If you have your own side business, there's all kinds of things to do there. If the numbers are large and generally above 250K, then there start to be what we call the exotics, where there's all kinds of secondary marketplace kind of things to do out there in the tax world. Um, so yeah, there's kind of defense on the front end of preventing the money from hitting your personal tax world in the first place, and then there's offense where once it does, then you go out and do something with it in order to create a lower taxable net income. So that's kind of the two ends of the spectrum with retirement money.
Okay. So we have a question about when the IRS will open up for 2024.
So
So, oh,
go ahead.
okay, good. So the client wants to know, do you have a range of dates that the IRS will open up? Is it January or February? And will that date affect like 1040s, 1120s, like all the tax returns, or each one has a different date, each return?
Yeah, so there's two different, well, there's actually three different answers to that. So answer number one is that in the beginning of January, usually, typically, um, the IRS will make an announcement and they'll say we are opening for e-filing on this date, and usually it's third or fourth week of January. I have seen it go past that, and the second factor that dictates whether they open for e-filing or not is the forms. So, like we were just looking at the 2024 1120S, every year the forms change a little bit. And there's a whole process that the IRS goes through as far as revising the forms, making sure that they work, all the math is correct, all the software vendors have implemented the forms correctly. And most years it's fine. Some years has been a disaster. So like in 2012, tax year 2012, so early 2020, 2013, it was so bad that there were tax returns we could not file until the end of March, just because the forms were not ready. Um, and it just has to do with what tax law changes come into place, how the computer systems are working at the IRS and all this kind of stuff. So I don't anticipate any major problems with either one of those two issues this year. So they're probably going to open third or fourth week of January, and that will probably open for most, if not all, tax returns. Every once in a while, there's like one or two forms that kind of are stragglers, and if you're one of those people who have one of those forms, then you're kind of stuck waiting. The third issue with filing tax returns is that if you are getting a refundable credit, and this was a change going back to 2018, maybe something like that. If you're getting a refundable tax credit, meaning child tax credit, earned income tax credit, American Opportunity Credit, and those are the big three. So kids and colleges. If you're getting one of those three, even if you submit your tax return early, they will not pay you until at least February 15th. So they'll just sit on your tax return and they'll wait and wait and wait. February 15th rolls around, then they'll put you in the list to be paid out for refunds anyway. So those are the three factors. So one is overall system opening, dependent on how well the IRS has their act together. Second is forms, depending on IRS, depending on law changes, depending on software companies' implementation. And the third is refundable tax credits. That's February 15th at the earliest. So yeah, that's usually how it goes. Past couple of years have been fairly smooth, to be honest.
Yeah, that's true.
They seem to have ironed out some kinks over the last couple of years.
Yeah, that's true. Because they were kind of crazy before that.
Yeah. Even the that one year during COVID when they were paying out people's child tax credit ahead of time,
Oh
even that went
yeah,
through relatively easily, which I was very surprised about.
that is so true. It was very smooth, and that was strange because they're never smooth.
Yeah.
So we have a divorcee question.
Uh-huh.
A client wants to know, I just went through a divorce this year, and I'm not sure
Uh-huh.
how to handle my tax filings. I don't know if I should file head of household or single, and I'm so confused about how to claim deductions for alimony and child support. What should I
Huh.
do?
Well, let's start with child support. Child support is not taxable income and it's not a taxable deduction. So it's just nothing tax wise. Um, Now, as far as filing your taxes goes, it's whatever your status is on 12/31 of this year, right? So we're coming up in 2 weeks, it'll be 12/31, and then if you are divorced on that date or before, you file divorce for the whole year. Now, if you're divorced, you're either going to be single or you're going to be head of household, depending on if you're claiming children. Most divorce settlements will dictate who's getting the kids for tax purposes. Now, this is actually an interesting thing that happens. So, if you read the IRS regulations, uh, there's some tiebreaker scenarios, but by and large, whoever gets whoever the child or children live with more than half the time is the one who's entitled to the tax deduction. The courts do not always agree. And so you can get into this back and forth thing where it's like, okay, Jimmy lives with mom, and the court decree says dad gets to claim Jimmy on his tax return, at least this year, because sometimes they'll alternate. There's different arrangements. And mom says, I don't care what the court says. He lives with me. I'm going to claim him. And she files a tax return. And then later on, dad tries to file a tax return with Jimmy as a dependent. And dependency is what creates head of household if you're a single person. And it gets rejected. And dad says, the court decree says I get Jimmy this year. So what gives? And what can end up happening is both parents try to claim. The IRS will do their own little investigation, and they have their own rules. They don't care what the court says, and so under their rules, they'll determine who gets the deduction and will accept that tax return. Um, Now, the flip side of that is that even if that's what happens, you can always go back to court and say, hey, mom didn't follow the divorce decree, and so she owes me money for the economic impact that this had. And the court can then go around the IRS and say, okay, mom, you give dad whatever, $3,000, whatever the economic impact was. So there's a battle there where if you have a particularly acrimonious divorce, these things do kind of pop up. So what is better is if everybody agrees to follow what the court says in whatever divorce decree lays out. And sometimes it'll be Jimmy always goes with mom, Jimmy always goes with dad, or they alternate, back and forth for tax purposes. And as long as there are no conflicting filings, then those will process through just fine. It's when there's conflicts that creates problems and creates delays and all these kinds of things. Now, as far as alimony goes, alimony under the Tax Cut and Jobs Act is treated the same as child support. That means nothing. It's not a deduction. It's not income. If you
Mhm.
got divorced before the Tax Cut and Jobs Act went into effect in 2017, then it was a deduction for the payer and it was income for the recipient. So,
Mm.
there are people who are still paying alimony from prior to 2017. They are still entitled to that deduction, and the people receiving alimony from a divorce that originated before 2017, they are still required to pay income tax on that income. Uh,
Wow.
but assuming that you are talking about a this year divorce, 2024, then it's not a deduction, it's not income. And so that really changed the math significantly
Right.
on divorce settlements and all that kind of stuff. Um, the other thing I will mention is quadros. So um, if a lot of times what happens is that in a divorce settlement, somebody has a large 401k or other kind of retirement balance, and the court will order um, the 401k or whatever to be split. Now, I have seen it go okay, and I've seen it go horribly wrong. So,
Mhm.
what you want in that case, what you want to do is, if you're the one paying, you want that to be a quadro where your retirement funds get split into your ex-spouse's retirement funds, not as a distribution to you, but as just a split rollover. And that way you don't have to pick up any income from a distribution. I have seen cases where in this case it was the husband had to pick up income as a distribution and then had to pay tax on it and still had to pay the full amount over to the ex-wife. Um, and that is just horrendous because then you're paying 30% tax, let's say, on an amount that you never got. So that is brutal from a tax perspective. Um, but yeah, so status as of 12/31, are you claiming the kid or not, or kids? That puts you out of
Mhm.
household or not.
Mhm.
Um, and then if you're divorced and not claiming the kids, you're just single. Alimony is if it's recent, it's not income. Child support, not income. And then also, similarly, it's those are not deductions. I think I covered all the cases there.
Yep, we did. So we have a question about car purchase. So client wants me to double check with you, Neal, whether the purchase of a vehicle will still count for 2024, even if the delivery is delayed until the following year. Now they haven't signed the actual paperwork, right? Until the vehicle arrives in 2025, but they have
Yeah.
made a deposit in 2024,
Yeah, it's a little bit of gray area. It gets into what's
right?
called constructive receipt. Um,
Yeah.
so, constructive receipt is basically the the asset or the money is released to you whether or not you've received it. So this happens a lot with um, somebody writes you a check, right, and you hold it and you don't cash it till the new year, right? That is technically not the way it's supposed to be done. So if somebody hands you a check and they are good funds, meaning that the check would clear, then you're supposed to report that in the year that you receive it, whether or not you cash it. Same thing here. So if the car is if it's paid for and available to you, but it's still kind of like in transit or whatever, then you could probably make an argument that it's a this year deduction versus a next year deduction. But you'd really have to dig into the details of that situation to figure out where it really belongs. Um, but yeah, that's the basic idea.
So like definitely a depend question.
Yeah, very much it depends. Depends on the exact sequence of events and the
Right,
exact language of whatever contract you have.
right, right. So it's 5:54. Well, my time, 5:54.
Yep.
What do we have time for one more question or
Let's
what?
do one more real quick.
Okay.
It's the last one for
Uh
the year. Good.
right, right, right. So a client wants to know, so they have a full-time job, but they also work as an Uber driver and do freelance writing.
Okay.
They want to know. They want to know. They need to report. How do they report all their income? Because they're worried they'll miss something or make a mistake. How should they go about it when it comes to filing their tax return?
Well, I mean, the easy answer is don't make a mistake. But
That's true. I was going to say
so
that too.
so you have a day job, so you're getting a W-2. So that's going to be the third party reporting that you're going to include in your tax return. The Uber driving, whether it's Uber or Lyft or DoorDash or whatever, they're all going to give you a report of some kind. It could be a 1099, it could be just uh, a form, depending on how much it is. And so that's going to show you your revenue. And so that's going to be the number to match up against. The writing is if you're doing freelance work, then it's pretty much on you in most cases to report accurately. And part of owning your own business or doing your own thing or what have you is the responsibility of keeping track of all this kind of stuff. So ideally, you would be able to produce a profit and loss for each of these activities, not the day job, but the Uber and the writing, in order to report those on your tax returns. How they get reported depends on your business setup. It could be Schedule C's, it could be Schedule E as a royalty for the writing stuff. It could be 1120S, it could be 1065, it could be 1120. What form it goes on depends on the tax structure of your life, and obviously a lot of I've got whole courses on how to do that. But so that's the basic idea. The easy way to do that is you have a separate bank account for each thing. Um, so your personal life, your day job is going to be one bank account. Your Uber is going to go a different bank account, and so that's going to be revenue coming in, and then direct expenses going out. And then your writing is going to have its own bank account. And whether you have an LLC or it's personal name, these are all discussions to be had. But if you just keep everything segregated, so that when it comes time to actually do this documentation that you forgot to do all year, then it's easy to follow up with it if each account is its own thing. And in fact, you can use my if you do that, you can go to the Explorers group. One of the free tools that's in there is the Quick and Dirty Bookkeeping Guide or Quick and Dirty Bookkeeping System, and that allows you to actually upload your bank statements. It'll create a profit and loss for you, which is an amazing little piece of technology that I put together that is still in progress, but even the beta version that's out there works phenomenally. So speaking of which, that is the end of It Depends for 2024.
Yeah.
So what do you do next? You become an explorer. Go to taxsherpa.com/explorer. You sign up there. It's free. And you'll get stuff like the Quick and Dirty Bookkeeping System. You'll get the partnership guide, which is the 13 questions to discuss with your partner before you go into business. These are all 13 of these are from real life experience, things that I've gone through, things I've seen clients go through of ways partnerships go bad. And so if you define the not just the events, but you define the response that you'll have to the event before it happens, that'll put you in huge in a huge advantage. Because there are some things like, let's say your partner dies, just unexpectedly, something happens. Um, and then that your partner's interest in your partnership goes to your partner's heirs, and you might not know those people, you might not like those people. Do you want a sudden unexpected new business partner or business partners? Maybe your old partner, maybe you were 50-50, but now you're 50 25 25 or 25 20 and 5, because you have three new partners for whatever reason, because their estate could be settled all different kinds of ways. Um, so, these are things to define on the front end so that you have mechanisms in place to prevent those unwanted situations at the back end. So really, really important guide. Everybody who comes to me and says, "Oh, I'm thinking about starting this partnership," I'm like, read this, please. Have these discussions with your potential partner so that you can both agree on the front end. It's like, okay, here's what we would do in this scenario. Write it down, include it as part of your operating agreement. And then, we have a forum. We have these calls where you can submit questions every week. We have one thing about the forum is that we've been getting some spam lately, just people posting nonsense. So we will ban you if that happens. But hopefully, people will use Tax Sherpa responsibly, I guess. And but yeah, go ahead and sign up there. You'll get all our emails and all the other stuff that comes along with being part of the Tax Sherpa community. So with that, we are coming to the end of 2024. We are at the end of this show. And so I hope everybody goes forward into 2025 really successfully. I think it's going to be a great year, to be honest. And the goal is, make a whole bunch of money and keep it. So let's keep our $1 trillion in our pockets rather than handing it over to the government. So with that, we'll see you next year.
Happy holidays. Merry
Happy
Christmas.
holidays.
Happy New Year's.